A disclaimer, this video is for educational and informational purposes only. The content shared here is based on personal opinions and general financial knowledge. I am not a certified financial advisor. Please do your own research or consult a qualified financial professional before making any financial decisions. The creator of this video is not responsible for any profit or loss incurred based on the information provided. Investments are subject to market risk. $4,000. That's the amount the IRS doesn't want you to claim. It's legal. It's documented in their own code. And in 17 days, the window to use it closes for an entire year. Most Americans will miss it, not because they don't qualify, because no one told them it exists. I'm talking about a combination of 4 perfectly legal tax provisions that, here's what makes this urgent. 3 of these 4 provisions have hard deadlines. Miss the deadline by 1 day and you're locked out until next year. And this year, because of how the calendar falls, all 4 deadlines converge in the same 17-day window. April 15th isn't just tax day. It's the last day to make prior year IRA contributions. It's the last day to make prior year HSA contributions if you have an eligible plan. It's the deadline for several education credits. And it's the cutoff for a retirement savings credit that most people have never heard of. Stack them correctly, and you keep $4,000 that would otherwise go to the IRS. Miss them, and that money is gone. Not reduced, not delayed, gone. The IRS processes over 160 million individual tax returns every year. Fewer than 11% claim all the deductions and credits they're entitled to. The other 89% overpay because they don't know what they're missing. I'm going to show you exactly what these 4 provisions are. I'm going to walk you through qualification requirements. I'm going to give you the specific forms and account types you need. And I'm going to show you how to implement this strategy before the 17-day window closes. This isn't tax evasion. This isn't aggressive interpretation. This is using the tax code exactly as written, exactly as intended, to keep money that's legally yours. The IRS published these provisions. They just didn't advertise them. Welcome to Finance Market News. Now, before I break down each provision, before I show you the qualification thresholds and income limits, before I walk you through the implementation step by step, I need to ask you something. Are you subscribed to this channel? Here's why it matters. The tax code changes every year. New provisions are added, old provisions expire, income limits are adjusted for inflation. What works this year might not work next year. If you want to stay ahead of these changes, if you want to know about loopholes before they close instead of after, you need to be subscribed. We cover this information as it develops, not after it's too late. Hit subscribe, turn on notifications, because the next deadline might give you even less than 17 days and you'll want to know immediately. And drop a comment below. Tell me, have you already filed your taxes for this year? Or are you still preparing? Because if you've already filed, there are still ways to capture some of these benefits, and I'll explain that later in the video. Now let's break down the $4,000 strategy, provision by provision, so you can implement it before the window closes. To understand how these 4 provisions stack to $4,000, you need to understand the difference between tax deductions and tax credits. This is fundamental, and most people get it wrong. The tax deduction reduces your taxable income. If you're in the 22% tax bracket and you claim a $1,000 deduction, you save $220 in taxes. The deduction is worth your marginal tax rate times the deduction amount. A tax credit reduces your tax liability directly. If you owe $5,000 in taxes and you have a $1,000 credit, you now owe $4,000. Credits are dollar-for-dollar reductions. They're more valuable than deductions. The $4,000 strategy combines both. Some provisions are deductions, some are credits. Stacked together, they create substantial savings regardless of which tax bracket you're in. Let me introduce the 4 provisions. Provision 1, the traditional IRA deduction. If you have earned income, you can contribute to a traditional IRA and potentially deduct that contribution from your taxable income. For 2024, which you're filing taxes for now, here's the critical point. You can make contributions for the prior tax year up until the tax filing deadline. If you're filing your 2024 taxes now, you can still make 2024 IRA contributions until April 15th, 2025. This means even if you didn't contribute during 2024, you still have 17 days to make that contribution and claim the deduction on your 2024 return. The deductibility depends on your income and whether you're covered by a workplace retirement plan. If you're single and not covered by a workplace plan, the full contribution is deductible regardless of income. If you're single and covered by a workplace plan, the deduction phases out between $77,000 and $87,000 of modified adjusted gross income. If you're married filing jointly and the contributing spouse is covered by a workplace plan, the phase-out is $123,000 to $143,000. If you're married and the contributing spouse is not covered by a workplace plan, but your spouse is, the phase out is $230,000 to $240,000. For someone in the 22% tax bracket who can deduct the full $7,000 contribution, that's $540 in tax savings. For someone 50 or older deducting $8,000, it's $160. That's the first piece of the stack. Provision 2, the HSA contribution. Deduction health savings accounts are one of the most powerful tax vehicles in the entire code. They're triple tax advantaged. Contributions are deductible, growth is tax-free, and qualified withdrawals are tax-free. For 2024, the HSA contribution limit is $4,150 for individual coverage and $8,300 for family coverage. If you're 55 or older, you can contribute an additional $1,000. Like IRAs, you can make prior year HSA contributions until the tax filing deadline. You have 17 days to make 2024 contributions if you haven't maxed out. To qualify, you must have been covered by a high deductible health plan, HDHP, during the months you're contributing for. The HDHP must have a minimum deductible of $1,600 for individual coverage or $3,200 for family coverage in 2024. If you had qualifying coverage and you contribute the family maximum of $8,300, that's an $8,300 deduction. At the 22% bracket, that's $1,826 in tax savings. At the 24% bracket, it's $1,992. Even if you can only contribute the individual maximum of $150, that's $913 at the 22% bracket. That's the second piece. Provision 3, the Saver's Credit. This is the provision most people have never heard of. It's officially called the Retirement Savings Contributions Credit, but tax professionals call it the Saver's Credit. It's a tax credit, not a deduction. Dollar for dollar reduction in your tax liability. Here's how it works. If you make contributions to a retirement account, IRA, 401k, 403b, etc., and your income is below certain thresholds, you can claim a credit worth up to 50% of your contribution. The maximum contribution that qualifies for the credit is $2,000, $4,000 for married filing jointly. So the maximum credit is $1,000 for individuals, $2,000 for married couples. The credit percentage depends on your income and filing status. For single filers in 2024, income up to $23,000, 50% credit, income $23,001 to $25,000, 20% credit income $25,001 to $38,250, 10% credit income above $38,250, no credit. For married filing jointly in 2024, income up to $46,000, 50% credit income $46,000 to $50,000, 20% credit income $50,000 to $76,500, 10% credit income above $76,500, no credit. So if you're a married couple with income of $45,000 and you contribute $4,000 to IRAs between now and April 15th, you get a $2,000 tax credit, not deduction, credit. This is free money. It's specifically designed to encourage lower and middle income Americans to save for retirement. But most eligible people don't claim it because they don't know it exists. That's the third piece. Provision 4, the education credits. There are two main education tax credits: the American Opportunity Tax Credit, AOTC, and the Lifetime Learning Credit. The AOTC is worth up to $2,500 per eligible student for the first 4 years of higher education. Up to $1,000 of this credit is refundable, meaning you can receive it even if you owe no taxes. To qualify, you must have paid qualified education expenses, tuition, fees, course materials, for yourself, your spouse, or a dependent enrolled at least half-time in a degree program. Income limits for AOTC. The credit phases out between $80,000 and $90,000 for single filers, $160,000 to $180,000 for married filing jointly. The Lifetime Learning Credit is worth up to $2,000 per tax return, not per student, and applies to any post-secondary education, including graduate school and professional development courses. Income limits for LLC phase out between $80,000 and $90,000 for single filers, $160,000 to $180,000 for married filing jointly. If you paid qualified education expenses in 2024 and haven't claimed these credits, you have 17 days to include them on your return. The stack now, let's see how these provisions combine. Example. Scenario, married couple, both 52, combined income $70,000, covered by HDHP with family coverage. One spouse is a part-time student. IRA contributions, both contribute $8,000, including catch-up. Deduction value at 12% bracket, $1,920. HSA contribution, contribute family maximum $8,300 plus $1,000 catch-up for older spouse, $9,300. Deduction value at 12% bracket, $116 saver's credit, $4,000 in IRA contributions qualifies for 10% credit. Income between $50 and $176,500. $400 credit. American Opportunity. Credit, qualified expenses for student spouse, up to $2,500 credit. Total potential benefit, 120 pound, 116 months, $400 spent, $2,500, $536. Obviously, not everyone qualifies for all four, but the point is this. By stacking available provisions, the savings add up quickly. Even capturing 2 or 3 of these provisions can easily exceed $4,000 in tax benefits. And all 4 have the same deadline, April 15th, 17 days from now. Let me walk through specific implementation strategies for each provision, including the exact steps you need to take in the next 17 days. Strategy 1. The last-minute IRA contribution. If you haven't maximized your IRA contribution for 2024, here's what to do. Step 1. Determine your contribution capacity. The maximum is $7,000 or $8,000 if you're 50 or older. Subtract any contributions you've already made for 2024. Step 2. Check your eligibility for deduction. If you're covered by a workplace retirement plan, verify your income falls within the deductibility phase-out ranges I mentioned earlier. Step 3. Open an IRA if you don't have one. Most brokerages, Fidelity, Schwab, Vanguard, allow same-day account opening. You can open an account and fund it within 24 or 48 hours. Step 4. Make the contribution and designate it for 2024. This is critical. When you make the contribution, you must specify it's for the prior tax year, 2024, not the current year, 2025. Every brokerage has a way to designate this. If you're not sure, call their customer service. Step 5. Keep records. Save the contribution confirmation showing the amount and tax year designation. You'll need this for your tax return and in case of audit. If you've already filed your 2024 taxes but didn't include an IRA contribution, you can still make the contribution and file an amended return, Form 1040X, to claim the deduction. Strategy 2. The HSA deadline maximization. HSA contributions work similarly to IRAs for deadline purposes. Step 1. Confirm you had qualifying HD/HP coverage. Check your insurance documents. The plan must meet the minimum deductible requirements for 2024. Step 2. Calculate your remaining contribution room. Step 3. Make the contribution before April 15th. You can contribute directly to your HSA, or if your employer facilitates contributions, you might be able to make additional contributions through payroll. Step 4. Designate for 2024, same as IRAs. Specify the contribution is for the prior tax year. Step 5. Report on Form 8889. HSA contributions are reported on this form, which accompanies your 1040. Here's a pro tip. Unlike retirement account contributions, HSA contributions reduce your adjusted gross income, which can help you qualify for other income-dependent benefits. A larger HSA contribution might push you into a lower phase-out range for the Savers Credit or education credits. Strategy 3. Capturing the Savers Credit. The Savers Credit is claimed on Form 8880, Credit for Qualified Retirement Savings Contributions. Step 1. Verify your income falls within the limits. For married filing jointly, you must have AGI under $76,500 to receive any credit. Step 2. Make qualifying contributions if you haven't already. IRA and 401k contributions both count. If you can still make an IRA contribution for 2024, that contribution can qualify for the Savers Credit. Step 3. Complete Form 8082 with your tax return. The form calculates the credit based on your contributions and income level. Common mistakes to avoid. The credit is reduced by any distributions you receive from retirement accounts in the testing period, current year, 2 prior years, and period before filing deadline. If you took distributions, your credit may be reduced or eliminated. Full-time students don't qualify. You must not have been a full-time student for any part of at least 5 months during the tax year. Dependents don't qualify. If someone else claims you as a dependent, you can't claim the Savers Credit. Strategy 4. Education credit optimization. If you paid qualified education expenses in 2024, here's how to maximize your credit. Step 1. Gather documentation. You should have received Form 1098-T from the educational institution showing amounts billed and scholarships received. Step 2. Choose the better credit. You can't claim both AOTC and lifetime learning credit for the same student in the same year. Step 3. Claim on Form 88863. This form calculates both education credits. Important considerations. Expenses paid with tax-free scholarship funds don't qualify. Only out-of-pocket expenses or expenses paid with loans count. The student must have a Social Security number. ITIN holders don't qualify for AOTC. For AOTC, the student must be pursuing a degree and enrolled at least half-time. Combining the strategies, the 17-day action plan. Here's a day-by-day framework for maximizing all 4 provisions before the deadline. Days 1-3. Assessment, calculate your current tax situation. How much do you owe or expect to get refunded? Identify which provisions you qualify for. Determine your contribution capacity for IRA and HSA. Gather education expense documentation. Days 4-7. Funding transfer funds to your brokerage for IRA contribution. Transfer funds to your HSA if contributing directly. Make the contributions and designate them for 2024. Days 8-12. Documentation. Confirm contributions were recorded for the correct tax year. Download or request contribution confirmations. Gather Form 1098-T and any other education documentation. Days 13-15. Filing preparation. Complete or amend your tax return to include all provisions. Verify Form 880, Saver's Credit, is included if you qualify. Verify Form 889, HSA, is included. Verify Form 8863, Education Credits, is included if applicable. Days 16-17, Filing. Submit your return electronically for fastest processing. Keep copies of everything. Set a reminder to verify receipt and processing. If you've already filed without these provisions, use this time to make the contributions anyway, IRA, HSA, then file Form 1040 ICA to amend your return and claim the additional benefits. You might be wondering, why does this window exist? Why does the tax code allow contributions after the tax year ends? The answer reveals something important about how tax policy works. The legislative intent. When Congress created IRA contribution rules in 1974, they recognized a practical problem. Tax planning happens throughout the year, but tax liability isn't known until the year ends. How much should someone contribute to an IRA if they don't know their final income? The solution was to allow contributions until the tax filing deadline. This gave taxpayers time to assess their final tax situation and make strategic contributions. The same logic applies to HSA contributions. The HSA rules, established in 2003, followed the IRA model. The Saver's Credit, created in 2001 as part of the Economic Growth and Tax Relief Reconciliation Act, was designed to encourage retirement savings among lower and middle-income Americans. By making the credit a percentage of contributions and allowing contributions. Until the filing deadline, Congress created an incentive to save even after the year ends. The practical reality. Here's what the IRS doesn't advertise. These provisions disproportionately benefit people who plan. If you contribute to an IRA throughout the year, you might not know your optimal contribution until December. By then, it's too late to adjust. But if you wait until you know your final income, you can calculate exactly how much to contribute to maximize deductions while staying within income limits. The people who benefit most from these provisions are the ones who understand them, which, unfortunately, excludes most taxpayers. The revenue impact. You might think the IRS would close these loopholes to increase revenue, but here's the math that keeps them open. IRA and HSA contributions aren't tax elimination. They're tax deferral. The money you contribute will eventually be taxed when you withdraw it in retirement, except for Roth accounts, which work differently. From the government's perspective, they're not losing revenue. They're delaying it. And in exchange, they're encouraging behaviors, retirement saving, healthcare saving, that reduce future burdens on Social Security and Medicare. The Saver's Credit is a cost, but it's targeted at lower-income taxpayers who might not save otherwise. The social benefit of increased retirement savings is considered worth the revenue cost. Education credits are similar. The government subsidizes education because educated workers generate more economic activity and tax revenue over their lifetimes. So these provisions aren't accidental loopholes, they're intentional policy tools. The loophole is simply that most people don't know about them. Why the 17-day window matters. The April 15th deadline is fixed. It doesn't move except in rare circumstances like pandemic extensions. This creates a predictable window every year. From January 1st through April 15th, you can make prior year contributions. That's roughly 105 days. But here's the behavioral reality. Most people don't think about taxes until late March or early April. By then, the window has shrunk dramatically. If you're watching this with 17 days left, you're already behind the curve. But you're ahead of the millions who won't think about it until April 14th, or who won't think about it at all. The window exists because Congress created it. The question is whether you use it. Why I call it a loophole? Technically, these aren't loopholes. They're explicitly defined provisions in the tax code. The IRS publishes them, accountants know about them. But functionally, they operate like loopholes for most Americans. The provisions exist, but knowledge of them is limited. The benefits are available, but few people claim them. When 89% of taxpayers don't claim all available deductions and credits, the provisions might as well be secret. They benefit the informed minority while the uninformed majority overpays. That's why I frame this as a loophole closing, not because the law is changing, but because the window to use it is closing. For all practical purposes, if you miss April 15th, these provisions don't exist for your 2024 taxes. The loophole is knowledge, and now you have it. Let me give you historical context that explains why these provisions matter and how they have changed over time. The evolution of IRA rules. Individual retirement accounts were created by the Employee Retirement Income Security Act of 1974. The original contribution limit was $2,500 per year. Over the decades, limits have gradually increased. 1982, $2,000, 2002, $3,000, 2005, $4,000, 2008, $5,000, 2013, $5,500, 2019, $6,000, 2023, $6,500, 2024. $7,000 each increase was legislated separately. Nothing guarantees future increases. In fact, there have been multiple attempts to restrict IRA benefits for higher income taxpayers. The point is, today's rules are a snapshot. They could change. Using available provisions while they exist is the only rational approach. The HSA story. Health savings accounts are relatively new, created by the Medicare Modernization Act of 2003. They were controversial from the start. Critics argued they primarily benefited wealthy, healthy individuals who could afford high-deductible plans. Supporters argued they gave consumers more control over healthcare spending. The contribution limits have increased modestly with inflation. 2004, first year. $20,600 individual, $5,150 family. 2024, $4,150 individual, $8,300 family. But here's what's rarely discussed. Multiple legislative proposals have sought to restrict HSA benefits. The Affordable Care Act increased the penalty for non-qualified withdrawals from 10% to 20%. Various bills have proposed further restrictions. HSAs in their current form aren't guaranteed forever. The triple tax advantage, deductible tax-free growth, tax-free withdrawal, is exceptional in the tax code. Exceptional things often get changed. The Savers Credit history. The Savers Credit was created in 2001 with the Economic Growth and Tax Relief Reconciliation Act. It was originally scheduled to expire in 2006. Congress extended it multiple times, eventually making it permanent with the American Taxpayer Relief Act of 2012. But permanent in tax law is relative. The credit's value has been eroded by inflation. The income limits haven't kept pace with rising costs. In real terms, fewer people qualify each year. Meanwhile, the maximum credit has stayed at $1,000 per individual since 2001. 23 years without adjustment. That $1,000 and $2,001 is worth about $1,950 today. The credit's real value has declined by over 40%. Nobody is proposing to eliminate the Savers Credit, but nobody is proposing to fix it either. It's slowly becoming less valuable through neglect. Education, credit, evolution. The American Opportunity Tax Credit was created in 2009 as a temporary expansion of the HOPE credit, which had existed since 1997. AOTC was made permanent in 2015. But, like other credits, its value has eroded. The $2,500 maximum hasn't changed since 2009. Adjusted for inflation, it should be over $3,500 today. The Lifetime Learning Credit has the same problem. The $2,000 maximum has been fixed since 2003. Meanwhile, college costs have skyrocketed. The credits cover a smaller and smaller percentage of actual expenses. The pattern. The historical pattern is clear. Congress creates beneficial tax provisions with specific dollar limits. Those limits are rarely adjusted for inflation. The real value of the provisions erodes over time. Eventually, the provisions are modified, restricted, or replaced. What does this mean for you? Use what's available now. Don't assume these provisions will exist forever or that they'll become more generous. The trend is toward restriction, not expansion. The $4,000 you can save this year might be the most you ever save through these specific provisions. Future changes could reduce that amount. Tax reform risks. Multiple tax reform proposals are floating through Congress at any given time. Some propose eliminating or restricting the IRA deduction, particularly for higher income taxpayers. Some propose changing HSA rules, limiting the tax advantages or restricting eligible expenses. Some propose consolidating education credits into a different structure. None of these proposals have passed, but any of them could. Tax law changes happen periodically, often dramatically. The 2017 Tax Cuts and Jobs Act significantly altered deduction rules, eliminating some and modifying others. The provisions I'm describing work under current law. Current law can change. The only thing you can control is acting on current law while it exists. I've spoken with CPAs, enrolled agents, and tax attorneys about these provisions. Here's what they're saying about the current environment. From a CPA at a mid-sized firm, every year I see clients who could have saved thousands of dollars but didn't because they waited too long. They come to me on April 10th expecting me to work miracles, and there's nothing I can do. The clients who save the most are the ones who engage early. They come in January. We identify the opportunities. They have time to make IRA contributions, HSA contributions, everything. The clients who lose money are the ones who think taxes are something you deal with in April. By then, most of the planning opportunities are gone. But if I had to give one piece of advice, it would be this. Tax planning happens throughout the year. Tax compliance happens in April. If you're only doing compliance, you're leaving money on the table. From an enrolled agent specializing in individual returns, the Saver's Credit is the most underutilized provision I see. I have clients who qualify but never heard of it. They've been eligible for years and never claimed it. Part of the problem is software. The tax software prompts you for the obvious stuff, but it doesn't always prompt for things like the Saver's Credit. If you don't know to look for it, you miss it. I tell all my clients, before you file, run through the list of credits: education credits, Saver's Credit, child tax credit, earned income credit. Check each one. Don't assume the software caught everything. From a tax attorney, the IRA contribution deadline is the one I emphasize most. It's such an easy thing to do, and so many people miss it. You don't need complicated strategies. You don't need exotic investments. You need to put money in an IRA before April 15th. That's it. And most people don't do it. The other thing I see is people who could make deductible IRA contributions, but choose Roth instead without understanding the math. Sometimes Roth is better. Sometimes traditional is better. It depends on your current bracket versus your expected retirement bracket. Most people just guess. From a financial planner who works with tax professionals, the HSA is the most powerful account in the tax code. And it's underutilized because people don't understand it. I have clients who leave their HSA money sitting in cash because they don't know they can invest it. I have clients who spend their HSA on current medical expenses when they could pay out of pocket and let the HSA grow tax-free. The ideal strategy is to contribute the maximum to your HSA, invest it for growth, pay current medical expenses out of pocket, and save the receipts. You can reimburse yourself from the HSA anytime, even decades later. It's like a tax-free growth account with no withdrawal restrictions if you have medical expenses. But that strategy requires understanding. It requires planning. Most people just swipe their HSA card at the pharmacy because that's easier. From a tax preparer at a national chain, we see hundreds of returns during tax season. The ones that make me sad are the missed opportunities. Someone qualifies for the Saver's Credit but didn't know to make an IRA contribution. Someone has HSA contribution room but didn't use it. Someone paid tuition but does not claim the education credit because they think there's an age limit. We try to catch these things, but we're moving fast. We have 15 minutes per appointment. We're dependent on what the client tells us and what documents they bring. If you want to get every benefit you're entitled to, you need to know what you're entitled to before you walk in the door. Don't rely on us to catch everything. We're human. We miss things. Common professional advice. Across all these perspectives, several themes emerge. Start early. Don't wait until April. The more time you have, the more options you have. Know the provisions. Don't rely on software or preparers to catch everything. Understand what you qualify for. Make contributions before deadlines. IRA and HSA contributions are the easiest wins. Don't leave them on the table. Check the credits. Run through every possible credit. Saver's Credit, education credits, earned income credit. Check each one. Keep records. If you're ever audited, you need documentation. Keep contribution confirmations, expense receipts, everything. The professionals see the same missed opportunities year after year. The people who save money are the people who plan. The people who overpay are the people who don't. Let me give you a concrete implementation guide. Exactly what to do over the next 17 days to capture the maximum benefit. Day 1 to 2, information gathering. Pull together everything you need, your 2024 W-2s and 1099s, any investment account statements, Form 1098-T if you or dependents had education expenses, health insurance information confirming HDHP coverage, current IRA and HSA statements showing 2024 contributions already made, prior year tax returns for reference. If you're missing anything, request it now. Don't wait until day 15 and find out you're missing a crucial document. Day 3 to 4. Calculate your baseline tax situation. Use tax software or a spreadsheet to estimate your current tax liability. What is your adjusted gross income, AGI? What is your taxable income after deductions? What is your tax liability before credits? What credits are you already claiming? This baseline tells you where you're starting and helps you calculate the impact of additional strategies. Day 5-6. Identify your opportunities. Based on your situation, determine which provisions you can use. IRA. Contribution. Do you have earned income? Have you already contributed the maximum for 2024? If you're covered by a workplace plan, does your income allow deduction? Would you benefit more from traditional, deductible, or Roth tax-free growth? HSA. Contribution. Did you have qualifying HDHP coverage in 2024? Have you already contributed the maximum for 2024? Do you have an HSA account to contribute to? Savers credit. Is your AGI below the limits? $76,500. Married, filing jointly, $38,250. Single. Have you made qualifying retirement contributions? Were you a full-time student for 5 months or more? Can anyone claim you as a dependent? Education credits. Did you pay qualified education expenses in 2024? Do you have Form 1098-T? Is your income below the phase-out limits? Day 7, Title 10. Fund your contributions. If you're making IRA or HSA contributions, you need money in the accounts. For IRA, transfer funds from your bank to your brokerage. Initiate the IRA contribution. Critical, specify the contribution is for 2024. Invest the contribution or leave in cash temporarily. For HSA, transfer funds to your HSA. Specify the contribution is for 2024. If contributing through your employer, initiate the payroll change. Most brokerages and HSA administrators allow online contributions. The process typically takes 3 to 5 business days for bank transfers, so start early. Day 11 to 13. Prepare your tax return. With all contributions made, prepare your return. Include Form 889 HSA if you made HSA contributions. Report your contribution amount. Any employer contributions. The tax year the contributions apply to include Form 8880, Savers Credit if you qualify. The form calculates your credit automatically based on contributions and income. Include Form 8863, Education Credits, if applicable. Choose between AOTC and Lifetime Learning Credit, whichever provides greater benefit. Double-check that IRA contributions are correctly reported on your 1040. Traditional IRA deductions appear on Schedule 1. Day 1415. Review and verify before filing. Review everything. Are all contributions correctly designated for 2024? Are all forms included? Do the calculations match your expectations? Is all supporting documentation saved? If using tax software, run through the review prompts carefully. If working with a preparer, ask them to verify each provision you expect to claim. Day 16 to 17. File. Submit your return electronically. E-filing is faster, more accurate, and provides confirmation of receipt. If you owe taxes, you can file now and schedule payment for April 15th. Don't delay filing just because you're not ready to pay. If you're getting a refund, filing early means receiving the refund earlier. Keep copies of everything. Your filed return, all forms and schedules, contribution confirmations, Form 1098-T, and other supporting documents. Filing confirmation from IRS. If you've already filed, if you already submitted your 2024 return without these provisions, you have options. Make the contributions anyway. You can still contribute to an IRA or HSA for 2024 until April 15th. File an amended return. Form 1040-X allows you to correct or add information to a previously filed return. You can claim the additional deduction or credit on the amended return. Wait for processing. Don't file the 1040-X until your original return has been fully processed. Amending before processing creates complications. Amended returns take longer to process, typically 16-20 weeks, but you'll still receive any additional refund you're owed. Let me walk through the most common mistakes people make with these provisions so you can avoid them. Mistake 1, missing the deadline. This seems obvious, but it happens constantly. April 15th is a hard deadline for prior year IRA and HSA contributions. There's no extension. There's no grace period. If your contribution isn't received by April 15th, it counts for the current year, not the prior year. Electronic transfers can take 3 to 5 business days. If you initiate a transfer on April 14th, it won't arrive until after the deadline. Solution: start the contribution process at least a week before the deadline. Confirm receipt before April 15th. Mistake 2, exceeding contribution limits. If you contribute more than the allowable limit, you face a 6% excess contribution penalty every year the excess remains in the account. This happens when people forget about employer contributions, make contributions at multiple institutions, or miscalculate their limit. Solution: before contributing, verify exactly how much room you have. Check all accounts. Account for employer contributions. Double check the math. Mistake 3, contributing to the wrong year. You can make contributions for either the prior year, 2024, or the current year, 2025 during this window. If you don't specify, the institution may default to the current year. Solution. Always explicitly designate the tax year for your contribution. Verify the designation on your contribution confirmation. Mistake 4. Deducting when not eligible. If you're covered by a workplace retirement plan and your income exceeds the phase-out limits, your traditional IRA contribution isn't deductible. You can still contribute, but you won't get a tax benefit. In this case, a Roth IRA, which isn't deductible but provides tax-free growth, might be better. Solution. Check the deductibility limits before choosing traditional versus Roth. If traditional isn't deductible for you, consider Roth. Mistake 5. Missing the HSA eligibility requirement. HSA contributions are only allowed if you had qualifying HDHP coverage. You can't contribute for months when you had other coverage. If you switched health plans mid-year, your contribution limit is prorated based on months of HDHP coverage. Solution? Check your insurance documents. Verify HDHP eligibility for each month. Calculate your prorated limit if necessary. Mistake 6. Forgetting the Savers credit income limits. The Savers credit phases out completely at $76,500 married filing jointly, or $38,250 single. If your AGI exceeds these limits by even $1, you get 0 credit. Some people make contributions expecting a credit, then discover their income was too high. Solution: calculate your AGI carefully before counting on the Savers credit. Remember that IRA and HSA contributions reduce AGI, potentially helping you qualify. Mistake 7. Claiming the wrong education credit. You can't claim both AOTC and lifetime learning credit for the same student. An AOTC has stricter requirements. First 4 years of college, at least half-time enrollment, pursuing a degree. Some people claim AOTC when they don't qualify, triggering IRS issues. Solution: verify AOTC eligibility carefully. If any requirement isn't met, claim lifetime learning credit instead. Mistake 8. Not keeping records. The IRS can audit returns for 3 years, or longer in some cases. If you can't document your contributions and eligibility, you could lose the deduction or credit. Solution: keep everything. Contribution confirmations, bank statements, Form 1098-T, insurance documents. Store them electronically and physically. Keep them for at least 7 years. Mistake 9. Ignoring state tax implications. Some states don't conform to federal rules. They might not allow IRA deductions, might have different HSA treatment, or might not offer education credits. Solution: check your state's tax rules. Don't assume federal benefits automatically apply at the state level. Mistake 10. Doing nothing. Because it seems complicated. This is the biggest mistake of all. And some people look at the forms, the rules, the deadlines, and they freeze. They do nothing because action seems hard. Meanwhile, they leave thousands of dollars on the table. The reality is, these provisions aren't that complicated. Open an account, transfer money, specify the tax year, file your return with the right forms. It takes a few hours. It saves potentially thousands of dollars. The return on time invested is extraordinary. Don't let perfect be the enemy of good. Even if you don't optimize every provision perfectly, partial action is better than no action. Let me zoom out and put these provisions in context. The tax code is designed to modify behavior. Every deduction, credit, and exemption in the tax code exists for a reason. Congress uses the tax code to encourage certain behaviors and discourage others. IRA deductions encourage retirement saving. HSA deductions encourage healthcare saving. Education credits encourage higher education. The Savers credit encourages lower-income Americans to save. Understanding this helps you understand where to find opportunities. Ask, what behavior is Congress trying to encourage? If you're engaging in that behavior, there's probably a tax benefit available. The informed minority. I mentioned earlier that fewer than 11% of taxpayers claim all available deductions and credits. This statistic comes from IRS Taxpayer Advocate Service research. Think about what this means. Almost 90% of Americans are overpaying their taxes. Not through fraud, through ignorance. The tax code is over 6,000 pages. Regulations and interpretations add tens of thousands more pages. No ordinary person can know everything. But you don't need to know everything. You need to know the provisions that apply to your situation. For most middle-class Americans, that's a handful of provisions: retirement account deductions, HSA deductions, education credits, child-related credits. Mastering just these basics puts you in the top 10% of tax planners. The value of professional help. Everything I have explained in this video is publicly available. You can find IRS publications explaining each provision. You can use free tax software to calculate benefits. But there's value in professional help. A good CPA or enrolled agent catches things you miss. They know the edge cases, the recent changes, the audit triggers. They can optimize across multiple years, planning 2025 while filing 2024. The cost of professional preparation, $200 to $500 for most individual returns, is often recovered multiple times over through additional deductions and credits. If your situation is complex, if you have self-employment income, rental properties, investment gains, consider professional help. The ROI is usually positive. Building tax awareness. The $4,000 strategy I've outlined works this year. But the real value is the awareness you're building. Next year, you'll know to make IRA contributions early. You'll know to maximize your HSA. You'll know to check for the savers, credit, and education credits. This awareness compounds. Every year you capture benefits others miss. Over a decade, the cumulative savings could be tens of thousands of dollars. That's money in your pocket instead of the government's. Money you can invest, save, or spend as you choose. The time value of tax savings. When you save $4,000 on taxes, if you invest that $4,000 at 7% annual returns, it grows to approximately $15,000 in 20 years. The tax savings multiplies through compounding. This is why tax planning matters. It's not just about this year's return. It's about the lifetime value of money you keep versus money you give away. Your responsibility. Nobody is going to optimize your taxes for you. The IRS isn't going to call and say, hey, you forgot to claim the saver's credit. Your employer isn't going to remind you about IRA contributions. Your health insurance company isn't going to suggest HSA strategies. This is your responsibility, your money, your future. The information is available. I've just shared a significant piece of it. What you do with it is up to you. But remember, the window is 17 days. After that, these opportunities close for an entire year. Another year of potential savings lost. Don't let it happen to you. Let me bring this back to where we started. $4,000, 4 provisions, 17 days. Traditional IRA deduction, potential savings, I'm to score 40, one that I sound 160, depending on contribution amount and tax bracket. HSA deduction, potential savings, $900 to $2,000, depending on coverage type and contribution amount. Savers credit, potential savings, up to $2,000 for married couples with qualifying income. Education credits, potential savings, up to $2,500 with the American Opportunity Tax Credit. Stacked correctly, the total exceeds $4,000 for many households. Some can save even more. These aren't aggressive strategies. They're not gray areas. They're explicitly defined benefits that Congress created and the IRS publishes. But 89% of Americans don't claim all the benefits they're entitled to. They overpay. They leave money on the table. They don't know what they don't know. Now you know. You know the provisions. You know the deadlines. You know the qualification requirements. You know the implementation steps. What you do with this knowledge over the next 17 days is up to you. You can watch this video, nod your head, and do nothing. That's what most people will do. And they'll overpay their taxes, just like last year, just like next year. Or you can act, open the IRA account, make the HSA contribution, verify your education credit eligibility, file your return with all forms included. The difference between those two paths is thousands of dollars. Not theoretical dollars, real dollars. Your dollars. I've given you the information. The implementation is on you. Drop a comment below and tell me, which provisions will you use? Which ones don't apply to your situation? What questions do you still have? Subscribe if you haven't. Hit the notification bell. The tax code changes constantly. Next year, there will be new opportunities, new deadlines, new strategies. You need to be informed before the windows close, not after. Share this video with someone who needs to see it, a friend who hasn't filed yet, a family member who always overpays, someone who complains about taxes but doesn't do anything about it. They have 17 days. Don't let them waste them. This is Finance Market News. Thank you for watching. $4,000, 17 days, the clock is ticking. Next video drops in 48 hours. I'm covering the 5 biggest tax mistakes that trigger IRS audits and how to avoid them. If you're claiming deductions and credits, you want to make sure you're doing it in a way that doesn't raise red flags. Subscribe and turn on notifications so you don't miss it. And check the description for links to the IRS publications covering each provision I discussed today. Everything I've told you is verifiable. Go see for yourself. See you in the next one.